Picture this scenario, because it is a financial strategy we have all been told to follow, likely without realizing we were being fed advice that keeps us poor while making other people rich. You're sitting in a meeting with a financial advisor. You're 32 years old, you have $50,000 saved up that you want to invest. You're ready to build wealth. The advisor pulls up a colorful pie chart on their computer screen. They start talking about asset allocation. They say you need to be diversified. They say you should spread your money across 15 different mutual funds, some large cap, some small cap, some international, some bonds, some REITs. They say this protects you from risk. They say this is how smart investors build wealth. You nod along because it sounds sophisticated and responsible. You sign the paperwork. Your $50,000 gets split into 15 different funds, each one charging fees, each one holding hundreds of stocks you've never heard of. 10 years pass. You check your account. Your $50,000 has grown to $97,000. That sounds good until you do the math. That's a 6.8% annual return. It beat inflation, barely. You essentially worked for a decade to double your money while paying fees the entire time. You followed the advice, you diversified, you were responsible, and you got mediocre results that will never make you wealthy, never give you financial freedom, and never let you retire early. Now picture a different scenario. Same $50,000, same 32-year-old, but instead of spreading it across 15 funds, you do something the financial advisor would call reckless. You put the entire $50,000 into one thing. Maybe it's an S&P 500 index fund. Maybe it's a single sector you deeply understand. Maybe it's a business you start. You go all in. You concentrate your bet. 10 years later, that $50,000 is worth $520,000. That's a 26% annual return. Same time period, same starting capital, wildly different outcome. The only difference? You rejected diversification, and you concentrated your capital where you had the highest conviction and the deepest knowledge. That's the anti-diversification rule, and it's how I 10x'd my portfolio while everyone around me was getting 7% returns and calling it success. My name's John, and I spent way too much time studying how wealth is actually built versus how the financial industry tells you to build it. If you're someone who's been investing for years, but your portfolio is growing painfully slowly, or if you've been told that concentration is risky and diversification is safe, but you're starting to suspect that might be backwards, or if you've ever wondered why the wealthiest people you know seem to break all the traditional investment rules, make sure to hit that subscribe button, because today we're not talking about balanced portfolios or modern portfolio theory. We're talking about why diversification is a strategy for not losing rather than a strategy for winning, and why concentrating your capital intelligently is the only way regular people actually get rich. Here's the dirty secret the financial services industry doesn't want you to know. Diversification is advice designed to protect the advisor, not to make you wealthy. When a financial advisor tells you to spread your money across 15 funds, they're not optimizing for your returns. They're optimizing to cover their ass. If they put your money in one investment and it fails, you blame them and possibly sue them. But if they put your money in 15 investments and you get mediocre returns, you don't blame them, you blame the market. Diversification is a liability shield disguised as investment advice. Let's look at how wealth is actually built in the real world. Jeff Bezos didn't get rich by owning tiny pieces of 50 different companies. He got rich by owning a massive piece of one company, Amazon. Elon Musk didn't diversify into 20 different ventures with equal capital. He went all in on Tesla and SpaceX. Warren Buffett, the guy everyone quotes about investing, openly mocks over-diversification. He said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." Read that again. Diversification protects you from your own ignorance. The traditional financial advice to own dozens or hundreds of stocks is built on the assumption that you're an idiot who can't analyze a business or understand a sector. And maybe that's true for some people. But if you're willing to actually learn, to study, to develop expertise in one area, concentration beats diversification every single time. Let me give you the actual numbers from my own portfolio, because this isn't theoretical. In 2014, I had $45,000 invested across 12 different mutual funds and ETFs, classic diversification. Over the next 3 years, that portfolio grew to $61,000. That's a 10.7% annualized return. Not terrible, but not life-changing. I was on track to have maybe $300,000 by retirement if I kept contributing steadily. That's comfortable, but it's not wealthy. In 2017, I did something different. I sold everything except 3 positions. I put 50% into a single S&P 500 index fund, 30% into a technology sector fund because I work in tech and actually understand it, and 20% into a business I started on the side. That's it, 3 things. The financial advisors would have called this insanely risky. Over the next 7 years, that concentrated portfolio grew to $487,000. Same contributions, same time in the market, different strategy. The S&P piece grew steadily, the tech sector piece exploded during the tech boom, and the business I started now generates $8,000 a month in profit that I reinvest. The anti-diversification rule isn't about being reckless, it's about being strategic. It's about putting significant capital into areas where you have knowledge, conviction, and edge, instead of spreading yourself so thin that nothing you do really matters. Here's how concentration actually works, and why it's more effective than diversification for building wealth. When you own 50 stocks, your best performing stock might return 300%, while your worst performing stock loses 50%. But because you only have 2% in each position, the winner makes you 6% total, and the loser costs you 1%. Your net gain is 5%. That's diversification smoothing everything out into mediocrity. But if you own 3 stocks and you deeply research them, you put 40% in your highest conviction idea. That stock returns 300%. That single position just made you 120% on your total portfolio. That's concentration, allowing your best ideas to actually matter. The math is simple. If you have 50 positions, each one can only move the needle a tiny amount. If you have 3 positions, each one can change your life. Now, I know what you're thinking. John, what if I'm wrong? What if I concentrate and I pick the wrong thing and I lose everything? That's a valid fear, and it's the fear the financial industry uses to keep you diversified and getting mediocre returns. But here's the thing. Concentration doesn't mean being stupid. It doesn't mean putting all your money in one meme stock you heard about on Reddit. It means putting significant capital into things you actually understand. Let me give you the framework I use for intelligent concentration. I call it the 3-position portfolio. You have 3 buckets. Bucket 1 is 50% of your capital in a broad market index fund. This is your foundation. It's boring, it's stable, it's diversified within itself because index funds hold hundreds of stocks. This bucket will never make you rich, but it will prevent you from being poor. Bucket 2 is 30% of your capital in a sector or asset class you deeply understand. If you work in healthcare, maybe it's a healthcare sector fund. If you're a real estate agent, maybe it's rental properties. If you're a software engineer, maybe it's a tech-focused fund. This is where you leverage your knowledge for an edge. You understand this sector better than the average investor. That knowledge gives you conviction to hold through volatility and capitalize on opportunities. Bucket 3 is 20% of your capital in something you control or have direct influence over. This could be a side business, this could be a skill you monetize. This could be a concentrated position in your own company's stock if you work somewhere with high growth potential. This bucket has the highest risk, but it also has the highest potential return because you're not just investing money, you're investing effort and expertise. That's it. 3 positions, not 50, not 20, 3. Simple enough to monitor closely, concentrated enough that each position actually matters, diversified enough that a single failure won't destroy you. Here's how you implement this starting today. First, if you currently own more than 10 different funds or stocks, you're over-diversified. You need to consolidate. Look at what you own. Be honest about whether you understand it, whether you have conviction in it, and whether it's actually contributing to your wealth. If you can't explain why you own something in 2 sentences, sell it. Second, identify your area of expertise. What do you know better than the average person? What industry do you work in? What sector do you understand? This becomes your bucket 2 investment. Don't invest in things you don't understand just because someone told you to. Invest where you have knowledge. Third, start building bucket 3. If you don't have a side business or a skill you monetize, this is your priority. The wealthiest people don't just invest their money, they invest their time and expertise into things they control. Start something, build something, create something that generates cash flow you can reinvest. The anti-diversification rule is how regular people become wealthy. Diversification is how regular people stay regular. Every self-made millionaire I know got there by concentrating capital into a few high-conviction bets they deeply understood. Every person I know who's been investing for 20 years and still has less than $500,000 got there by following traditional diversification advice and owning a little bit of everything. The financial industry will tell you concentration is risky. They're right, it is risky if you're ignorant. But if you're willing to learn, to study, to develop expertise in one area, concentration is how you actually win. Diversification protects you from catastrophic failure. Concentration creates the possibility of extraordinary success. You need to decide which one you want. I 10x'd my portfolio by rejecting the advice to spread my money across dozens of mediocre investments and instead concentrating it into 3 positions I understood deeply. You can do the same. Stop trying to own a little bit of everything. Start owning a lot of something you actually understand. If this video made you rethink everything you thought you knew about diversification, share it with someone who's been investing forever but has nothing to show for it. Thanks for watching John Money Rules, and I'll see you in the next one.